Hi, a very good evening to you all. This is Kulbhushan from Marcellus. Thanks for your time today for our Kings of Capital webinar. And while it could have turned out either way, but this is a pretty interesting day as far as we look at financials. And events like today they keep happening over and over again in every bull and bear cycle, just to remind us that quality, good corporate governance, they all have their benefits, and they they become more and more visible to us in different cycles of time. Whether you look at maybe a global trust bank, you look at a Yes Bank, a DHFL, or situations like today. Let's say MFI's few months back when we did our last Kings of Capital webinar. While this is in general, today's specific point, of course, we'll talk about Kings of Capital, how it has done in the time since our last webinar, and what is the road ahead. Times are changing for sure, and this is where Tej and Keshav will present their side of thing. Tej, over to you.
Thank you, KB. So the content for today is as follows, which is that we're going to talk about a few things initially and then open it up for Q&A. We are going to start off with how we're looking at performance currently, and we're also going to then talk about what is our philosophy, what did we do over the last couple of years. Then we'll move on to where do we go from here, which will be covered by Keshav. And then finally, portfolio fundamentals. This is the here and the now. So the numbers 1, 2, and 3, I'll cover. 4 and 5 will be taken over by Keshav. In the end, we'll open it up for Q&A. So on portfolio performance, what we are seeing is last 1 or 2 months, as we have all seen, the markets have been quite turbulent. January and February were tough months across the board. We're seeing over here Nifty returns. If we look at 3-month Nifty returns, it's -8%. 6 months is -12%. And the small cap indices and mid cap indices have corrected even more. During this time period, we've fallen less than half of that of the Nifty. We've fallen in the 6-month and the 3-month period significantly lower than even the Bank Nifty. As a result of this, on a 1-year performance basis, we're now the top performing BFSI fund in the country. 20 mutual fund houses, PMSs put together who run actively managed BFSI funds at about 15.5% returns as on 20th Feb. We are number 1 across all of these 20 funds. Similarly, on a 1 and a 2-year period, we are outperforming both the Nifty and the Bank Nifty by a wide margin. On a 3-year period, we've still got some catching up to do. The way it arithmetically works is hopefully if our current performance and both relative and absolute performance sort of continues in 3 to 4 months time, 3-year number which is visible over here on the screen, which is about a 3.5 to 4% underperformance versus the Bank Nifty, that will start looking significantly better, hopefully by the time we present to you guys next quarter. So that's on performance. Finally, over the past 12 months, the style has come back in favor, which is quality, downside protection, all the stuff that we've been talking about for the past 3-4 years. So if we were to break down the performance which we saw on the previous slide, so period 1 was when we launched in July 2020 in the middle of COVID. From July 20 to October 21 in the COVID rebound, we did pretty well, 43% absolute returns. We're not really fussed about, us underperforming when the market is up 60-70%. We're not geared to do 60-70% sort of returns. When we own HDFC Bank or a Kotak Bank, I don't think in a single year in the past 10 years they would deliver a 60 or a 70% return. So we're quite happy sitting in October 21 with the sort of performance that we are sitting on. Especially with the sort of quality that we were owning then. And in July 2020, when we launched a financials fund, no one was thinking of launching a financials fund. So our timing was bang on when we launched the fund as well. It was the period from 21 to March 23, which was the tough period, which is the period of pain, because when the index delivered flattish sort of returns and we delivered a -19%, that was exactly not what we set out for. When we talked about downside protection, when we spoke about doing well in periods of stress, November 21 to March 23 proved to be quite the opposite. Not only did we deliver poor absolute returns of minus 20%, we also delivered poor relative returns. And during a time when the index did not do much. Typically in times like these, we would tend to deliver what we have done in the past 12 months, which is the index has done 1-2% sort of returns. We've done about 15%. That is what we would expect out of a portfolio of quality companies. And therefore, there was a lot of introspection. What could we have done? Where did we go wrong? And what are the sort of changes that we want to make in our process? And then came the last about 2 years, 2.5 years, where most of the underperformance of November 21 to March 23 has reversed. So we underperformed by about 15 to 20%, November 21 to March 23. Now we have outperformed by about 15% over the past couple of years. So most of the underperformance has reversed. If we were to now look back at that period of time and see what did we do during that period of pain, that is something that we would want to discuss with investors, both existing and prospective. So when we were sitting in that period of pain in, say, March of 2023, this is what we were staring at. Life insurance companies we owned, they delivered minus 30%. General insurance we owned, that had delivered minus 30%. And PSU banks and microfinance, which we had zero exposure to, had delivered plus 30 and plus 45. So we had gone horribly wrong across both our allocations, which were there in the portfolio, and things which we did not own did phenomenally well. And sitting there, we could have taken a call saying insurance as a sector in India is structurally gone. Structurally, maybe India has changed. PSU banks will perennially gain market share. We could have also discussed PSU banks, governance has changed. A lot of initiatives have been taken. Incrementally, things are looking great. And all of these things look great, especially when we've seen 2 years of 30% CAGR for PSU banks. You could have also discussed, microfinance underwriting has changed because regulations have become better. RBI has become more stringent. They've adopted technology better. India has become a much lower risk country because post-COVID, most of the defaults had already happened. There was nothing much left as an asset quality risk in the system. However, we have a philosophy which we stick to. We stuck to what we believed in. And therefore, if we were to look at what followed over the last 2 years, from post the period of pain, it is completely the opposite. We actually bought more of capital markets during the period of pain. We bought Prudent, we bought Motilal Oswal. That turned out to be the best performing segment of financial services. We did not give up on general insurance companies. We continued to own ICICI Lombard. We actually increased our weight in ICICI Lombard post the 30% correction. That turned out to be a good call. And vehicle financiers, we continued to hold on to Chola, which continued to do well both during the period of pain and the phase of reversal. And that is why we believe that unless we have a stated philosophy at a fund level, we'll end up chasing performance. And when you end up chasing performance, eventually you will end up underperforming. This is one of those things where the harder you try chasing alpha, this is a profession where it will become even more elusive. And we've seen that in the period of pain, if you would have chased anything which is doing well then, microfinance, PSU banks, multi-product NBFCs over here refers to NBFCs like L&T Finance, Poolamala FinCorp, both of them which delivered about 100% returns up to 2023. They massively underperformed over the past 12 to 18 months. So thankfully, we stuck to things which we knew about. Thankfully, we stuck to quality. And that is where we've seen most of the underperformance already reversed in the past couple of years. Keshav, we can move on. So that brings us to the question of what's our philosophy, because performance is something which will come and go. There is process that we can stick to, and hopefully the process will deliver over the long term. The biggest critique of this is any process which does not deliver should be changed, should be tweaked, and that was a test which we had to face during the period of pain. Where unless the process delivers outcomes, whether relative or absolute, that process should be changed. But we'll discuss what is the process that's worked for us, that's worked over the past 2, 3, 4 years. And in that process, what are the things that we like and what are the things that we don't like? So what are the things that we tend to stay away from, irrespective of what's happening in the market, irrespective of how tempting things might seem? The first thing that we try to stay away from is things that we do not understand. Just because those things are going up, we do not try and get them first into coverage, then try and value those things. And then it's quite tempting to put a target price and then start buying as and when those things start correcting. Examples of this would be fintech companies. We've found it extremely difficult to understand those business models. Even in good times, we stayed away from them. Currently, as we speak, obviously, they've gone through challenges. We stay away from them. Similarly, lenders which make supernormal profitability, these lenders lend at about 25-30% sort of interest rates. They make 7%, 8% return on assets. And we don't think this is sustainable. We might be wrong. But because, again, we don't understand how this is possible over a long period of time, we stay away from them. And we might be completely wrong, but we are fine with that sort of error of omission. As long as we don't understand these things, we'll stay away from them. Similarly, we stayed away from PSU banks and public sector NBFCs, even when we saw them doubling, tripling in a period of 12 months during 2022. This is, rather than a lack of understanding, this is not the sort of risk that we would want to take. We can see that they're making 18% return on equity, 20% return on equity, but they're levered 15 to 20 times. That's not the sort of risk that we want to take. And a good example of it is what's happening today in the market. A bit topical, but a 2.5% impact on net worth is what IndusInd Bank has quantified. That's resulted in a 30% erosion of wealth in a single day. If that 2.5% erosion of net worth would have happened for a PSU bank, that would have also resulted in a 40% return, 40% write-off on its net worth, because it's levered 20 times, 2% into 20 times would have been 40% net worth gone. And a stock which is trading at 1-time price to book, a PSU bank trading at 1-time price to book, after its net worth having being written off by 40%, would have been overnight trading at 1.5 times price to book. So again, these are things that we tend to stay away from. And then the last one is turnaround stories. All of these things come with a trade-off. It's not that we are avoiding them to avoid downside. Whenever these things do well, our fund will underperform. And not only has it done so in the past, even in the future, whenever we miss a turnaround like ICICI Bank, which is a large part of the index, we'll see relative underperformance for our fund. But we would want to take measured calls. All of it is focused on downside protection. We don't chase private banks which are going through turnaround. We don't chase management teams changing overnight and claiming that they've changed a lot of things at some of these lenders. We want to see long-term ROA, ROE, sustainability. We want to see management quality outperformance over long periods of time. And once that is there, we are okay to get these things into the portfolio. And that's what we did with ICICI Bank. We missed the initial turnaround. Once we understood what's going on, once we did our work, we got it into the portfolio. Moving on to the things that we like sustainable business models, which have historically demonstrated that they do well even during times of stress. Examples of this would be capital market plays like Prudent Corporate, nothing on the balance sheet, no debt, strong free cash flow generation, about 500 to 1,000 crores on the balance sheet as free cash lying idle. Private insurance companies, ICICI Lombard, HDFC Life, significantly lower risk than some of the smaller lenders that we own or that are available trading in the market. So other things that we like are private lenders, large ones, HDFC Bank, Bajaj Finance, Kotak Bank. We've been long-term shareholders in some of these companies. They've demonstrated across asset quality cycles that they not only demonstrate great risk management, but they also keep gaining market share. Third one is something which is a softer aspect, which is management teams which have been there for a long period of time and they've demonstrated that they can create shareholder value over long periods of time. This is not something which is visible in PSU banks just by their nature, because PSU banks see management teams changing every 3 years. This is not something which would be visible where promoters don't own a large part of the company. So Bajaj Finance and Chola are rare, not only because they are great risk managers, but also because promoters own a large part of the company. And finally, companies with excess capital. Whenever we see companies which are rebuked by the market saying they have excess capital which they are not deploying, actually that's the time when risk is at the highest, because things are going great. That is when management teams with excess capital are criticized. And what excess capital does both for lenders and non-lenders is, not only do you have a lot of room to make mistakes, you can go wrong. 1% increase in NPAs won't destroy your balance sheet, but you can also try and experiment with different things. So for example, a prudent corporate with about 500 to 1,000 crores of spare capital in its balance sheet can go wrong on a small acquisition. CMS Info, with about 800 to 1,000 crores of excess capital on its balance sheet, can afford to go wrong on a small acquisition that it makes. Versus if you don't have excess capital and you're levered 15:1, even small mistakes can erode your net worth by a meaningful amount. So therefore, we like these traits in companies we own. Moving forward. And therefore, our overall philosophy is focused on avoiding large mistakes. We're not chasing fads. We're okay giving up a lot of upside in companies we don't understand. We're okay giving up upside in things which fall outside our circle of competence, which is the things which we discussed a couple of slides ago. And that's what we've demonstrated. No real large errors of commission. And there has not been anything significant which has eroded a lot from fund performance. And this is from inception. So even in the last 2, 3, 4 months, we've not done or not seen anything which is down 30, 40%. And that is in the context of a market where about 30 to 45% of stocks are down more than 35%. We've not seen anything of that sort in our portfolio. And that is why it's post the last 2 months, during a time like this, that we have seen significant periods of outperformance. So we have a lot of blue bars over here, which are adding value. Hopefully in the future as well, we will not encounter a lot of orange bars. We've had some of them, and most of them are recent additions: CMS, ICRA, CredAg, MAS. These are the ones which we have added in the past 12 to 15 months, which are the orange bars. Other than that, we have not seen any significant large erosion of capital across any of the investments that we've made. And that's how hopefully how we'll see things going forward as well. And this comes from our allocation. So if you look at, this is a bit of a busy slide. If you look at all the possible segments which are available in financial services where we could allocate capital, the things on the right is where we've not allocated capital, and they've seen the most amount of drawdowns in the past 12 months. Microfinance, mid-tier banks, small finance banks, and PSU banks broadly have absolutely no allocation over there. And things are on the left, which is the thing, which are things which are which have traits which we discussed, which have excess capital, management teams which have skin in the game, These are the things which have historically added value and created shareholder value without a lot of debt, which is vehicle financer, top 4 private banks, capital marketplace, again, free cash flow generating businesses. These are things where we have got a lot of our portfolio. And then there are things like general insurance companies, cash management companies, life insurance companies in the middle, where the remaining of our allocation is there. So it's rather than forecasting things which will go bad in the next 6 or 12 months, it's more of a construct where we just don't allocate capital to things which are likely to go bad at any period or any point in time. Rather than forecasting next 12 months, maybe macro will be bad, macro will be good. We try and invest in companies which tend to do well and protect downside risk, irrespective of what the macro or the outside world will look like in the next 12 months. So moving on. So this was what we discussed about business traits, quality of businesses that we would like to own. And honestly, I've not seen anyone talking about, not willing to own quality businesses. Everyone wants to own quality businesses. Everyone wants to own great companies. But the issue is softer aspects, which is behavior. When do you want to stick to your philosophy during good times, during bad times? And that is why an important aspect of investing is not only the analysis part of it, which is knowing that Bajaj Finance is a great company, but also knowing that you need to stick to great companies during good times and bad, so as to outperform as and when Bajaj Finance comes back into favor. And an example of that over the past 12 to 18 months, actually quite a few examples of that that we have seen at a stock level are when Bajaj Finance saw a couple of its product being banned by the RBI. When in November 2023, Bajaj Finance saw its products being banned, it saw 10 to 15% drawdown during that month. We had two options. We either believed in all the work that we had done, our interactions with the management team, the numbers that we are seeing, our future forecasts of the business, quality of what was being built out, our belief in technology, so on and so forth, all the good stuff. Or we were to get caught up in the here and the now, which was the RBI ban, a bleak 6 to 12 months, and move out of the business and buy something else, which we definitely knew less about than we knew about Bajaj Finance. So we took a call of not trimming exposure. Actually, in the past 12 to 18 months, we would have barely trimmed our exposure to Bajaj Finance as a group. Now we have Bajaj Finserv, obviously, but Bajaj Finance plus Finserv put together, we barely trimmed exposure. The result of that is for 12 to 15 months, we were wrong. And we were pointed out as being wrong. But however, if you were to take a 18-month view, Bajaj Finance from the date of the ban has outperformed Bank Nifty. And most likely, had we bought anything else from our universe, we would have been worse off. Same thing with Kotak Bank. Kotak Bank, again, reminds me of today, IndusInd Bank seeing a lower circuit today. Kotak Bank saw a lower circuit on the day RBI banned a few of its products and internet banking, online banking. Again, we had two options. We could move out of Kotak Bank. We could move out of a bank which we had known for 5 or 6 years, interacted with the management. We could believe our numbers. And we could move out and buy something else which we would have definitely known less about. Or we could have stuck to Kotak Bank, which was anyways trading 15 or 20% lower than what we anyways believed was at lower than fair market value. So if we believed at 1700 or 1800 rupees, Kotak was trading below fair market value, there was no reason to believe at 1500 rupees for a temporary issue which was solvable, Kotak would, Kotak is not trading at less than fair market value. And therefore, again, out of the two options, we chose to stay invested. Thankfully, during the past 12 to 15 months, we've not sold a single share of Kotak. Kotak's again outperformed Bank Nifty. And again, this is an important point because we're not trying to optimize for our NAV, which is day after tomorrow, or our NAV for the month, or our NAV for the quarter. We're trying to think of this as business owners. We're trying to think of this as, is the business going to do well over the next 3 to 5 years? And is that all of that goodness already reflected in the stock price or not? And that's the only call that we are trying to take, rather than sitting in our shoes in April 2024 when the stock was down 10 to 15%. We could maybe have trimmed 3 or 4%, hoping that we'll buy more when it corrects 5 to 10% more, because the next 12 months look pretty bleak. The next 12 months have no triggers. There are no earnings which are visible, so on and so forth. But given that the next 3 to 5 years look as good as they looked before the RBI ban, we did not do anything. Moving on to the next slide. So what this slide tells us is that contrarian thinking is quite important within all of these buckets of financial services. And one example of that is if you were to look at, say, life insurance companies, or say capital markets is an extreme example. Capital markets in second half of 2020, what rank 12 means was the worst performing segment of financial services. However, by the time capital markets reached 2021, it was the best performing segment of financial services. And that's what we are seeing here currently as well. If you look at capital markets in CY24 as well, the best performing segment of the market, by the time we are in Feb of 2025, for the initial 12 months, for the initial 2 months, is the worst performing segment of financial services. So unless and until we are contrarian, unless and until we are going to parts of financial services where we have obviously comfort on governance, quality, so on and so forth, but which are completely out of favor, it's very difficult to make sustained alpha over long periods of time. So what we try and do is we try and repeat what we did with Kotak and Bajaj Finance. Parts of the market, parts of financial services where we hear things like these are structurally broken, where we hear things like these are not going to do well for the next 5 to 10 years, and which meet all our governance filters, those are things which interest us the most. And that's what we have tried to do over the past 2, 3, 4 years. Moving on. So, for example, this is our exposure. What this chart shows is our exposure to small and mid cap stocks. Over the past 12 to 18 months, when we heard that most people were talking about the only way to make money, large sums of money in India, is by mid and small cap stocks because they are not discovered. These are the stocks which will do well. These are the stocks which can grow at 20-25%. HDFC Bank or a Kotak Bank can grow at only 15%. That's the broader narrative which we were going through. During this period of time, our mid and small cap exposure, we trimmed down to its lowest level in the last 2 or 3 years. And the reason for that is it is very difficult to see how you cannot overpay for things when mid and small caps are up 3x in a period of about 2 to 3 years. Also, the narrative that large caps don't make money is quite of a fallacy, especially at a time when in the largest market in the world, in the US, we are seeing the top 8 or 10 stocks by market cap being the best performing stocks. It's very difficult to follow quite the opposite rationale sitting here in India. The only formula, therefore, that works in investing is to buy things below their intrinsic value, below their fair value, and then sit patiently. So what we did was we trimmed down our small and mid cap exposure over the past 12 to 18 months to its lowest level. We are now at 36% over the last couple of months. As we have seen 20-25% sort of drawdown in the mid and small cap space, we are now back to our normal sort of exposure to small and mid caps. Recent allocations are ICRA, Go Digit, Credit Access, Grameen. These are the stocks which we have added post about a 20 to 30% correction in all of these stocks. So we try and remain as countercyclical as possible, and then sit there patiently, hopefully for the market to discover what the true value of all of these stocks is. Next slide. Same thing with capital markets. We bought into Motilal Oswal and Prudent Corporate over the past 12 to 18 months. Our exposure was broadly at about 7 to 8% at any given point in time. By September 24, the capital markets index, which is the blue shaded area over here, that had also gone up by about 2.5 times in about 12 to 18 months time. Again, we saw that valuations were out of whack. We saw that most of these businesses could not trade at valuations that they were trading at for a long period of time. That's when we completely exited our capital markets exposure. Today, as we speak, we are at less than 1% exposure to capital markets. So the valuations that piece that I'm talking about is at the bottom of the slide. Say, for example, KFin is a business that we like. If you look at KFin, 1 year forward P multiple of KFin at 45 times earnings was the same stock available at half of its valuation about a year ago. Similarly, some of the other businesses we like, Prudent Corporate, trading at, again, 54 times earnings, great business. No matter how much we like the business, we thought we need to maintain valuation discipline, because again, it's trading at 2x the valuations it was trading at just 12 months ago. Same business, same free cash flow generation, same promoter, same traits of the business, trading at 2x the multiple. And therefore, again, being counter-cyclical, being true to what we say, we got down our exposure to less than 1% in capital markets as well. And we moved to other parts of the market, which we believed are more fairly valued. Yeah. Okay,
Sure.
so over to you, Keshav.
Sure, thanks, Tej. We'll cover where do we go from here. Tej has kind of put it out, our philosophy, some of our decisions that we have taken up until now. But where do we go from here? It's a question that we're trying to answer. It's a very pertinent question. And the first thing to kind of think of it about is the whole portfolio construct. Tej talked about us moving away from some of high. So the way to think about KCP will be in two different ways. There would be companies which are great capital allocators, which are towards the left side, which are companies which have low ROEs, typically lenders, but come with high reinvestment rate. So think about any Indian lender, you would think about, say, ROEs of about 15 to 20%, and they end up reinvesting almost all of it. So you generate growth of about 15 to 18% odd. At the same time, what we have done over the last 12 to 18 months is we have expanded our horizons. And to expand our horizons, we have added a lot of asset-light businesses. When I talk about asset-light businesses, talk about Naukri. 70% of India's job postings are largely through Naukri. Talk about a KFin Tech, which is a duopoly with CAMS. So both of them put together have 100% of RTA business of all mutual funds. You talk about Policy Bazaar, 93%, it's a leader. 93% of India's online insurance sales comes from Policy Bazaar. You talk about CMS, it's an ATM cash management company. More than 50% of ATMs are serviced by CMS. You talk about ICRA, again, a rating agency. Top 3 rating agencies in India command about 75% market share. You talk about Prudent, there are very few platforms which have scaled up as big as a Prudent. Only 2 come to mind, Prudent and NJ. So we're talking about businesses which we've added in last 12 to 18 odd months. And we're trying to diversify away from only lenders, whilst the Bank Nifty, which is the benchmark for us, has only lenders, but we think a lot of interesting quality businesses lies in the non-lending side, and a lot of them have been added in coverage. The names you are seeing are suggestive. Some of them could be part of portfolios. Some of them, could be names where we're waiting for valuations to correct further. But to give a broad horizon of where we are going from here, you will always see KCP having a combination of great capital allocators and some of the asset-light businesses. Now, the outcome will be as follows, which we're targeting. And these are all portfolio metrics. These are not stock specific, but as a portfolio, what we're essentially looking with this golden combination is if we could deliver high teen CPS growth, an ROE of about 20% odd. Valuation discipline will continue to maintain. So we are looking at valuations which perhaps should not be 20-25% higher than the index. And all of these are guiding principles, as I said. And finally, companies which have excess cash. Tej has already mentioned some of these can be used for adjacencies. Some of them could be used for acquiring and M&A. So that's the broad framework when you think about KCP.
And in addition to what Keshav's mentioned, this is, I would say, one of the most important slides of the presentation, this along with the behavior slide, because what we've seen is lenders are balance sheet businesses. They are likely to gain market share. The companies which are here on the top left, Bajaj, HDFC, Kotak, they're likely to gain market share for a long period of time to come. They're available today at great valuations. They will result in, and the combination of these 3 or 4 lenders will result in about 18 to 20% return on equity with 20% sort of growth. But they cannot expand beyond the license that they've been given to do by the RBI or by IRDA. A lender can only do lending, an insurer can only do insurance. That, along with things on the right side of the screen, a CMS, a Naukri.com, a KFintech, these are businesses which can utilize all of their excess cash to venture into completely different things, which we can't even think of sitting here today. So say in 2010, Naukri.com, which was generating a lot of excess free cash flow, started deploying it into startups. It deployed it into Policy Bazaar or Zomato, which we can see today. Similarly, a CMS was only a cash management business. Today, it does 5 other things because it generates surplus cash, because it generates a lot of free cash flow, and does not have any debt. Similarly, KFintech is not only a register and transfer agent. It does 5 other things. And because these businesses generate a lot of free cash flow and are very robust, these are businesses, irrespective of what the macro is, irrespective of what the lending cycle is, would continue to do extremely well. Most of these are oligopolistic or duopolistic sort of businesses, whether it's a KFin, whether it's a Prudent, whether it's a Naukri or a CMS or a Policy Bazaar or an ICRA. That is another trait which makes all of these businesses great businesses to own. And that, along with a balance sheet business, the balance sheet business would never trade at valuations of 60 times earnings. Bajaj Finance, no matter how great people would think it is, would never trade at 60 times earnings. Therefore, the advantage that a business has of owning a Bajaj Finance or a Kotak Bank or a HDFC Bank is you will for a very long period of time get book value compounding, because it will never trade at valuations which will be out of whack. You don't have to sell out of these companies for a long period of time. On the other hand, as we have seen in the past 12 months, a prudent corporate will trade at valuations of 60 times earnings because people will think that the capital market cycle will go on forever. And it's a business which is in favor. Market loves it during a bull market. Market would not like it during a bear market. But it is a very robust business. So some traits of lenders which we like, some traits of these cash flow generation businesses which we like, a combination of these two, when we create a portfolio, hopefully at fair valuations, at sensible valuations, we will be able to generate outcomes which will be better than the index. And the biggest reason that most active managers are not able to beat the index is valuations or quality of the business or emotions. Index does not have greed or fear. We're trying to eliminate all 3 of them over here. We're trying to eliminate better valuations than the index. So we're trying to get better valuations than the index, better fundamentals than the index, and hopefully we'll behave more rationally than the index. So as a combination of that, outcomes will follow. This is the process.
Since we're talking about where do we go from here, I thought it's pertinent to see how the stock prices have reacted to earnings. As you all know, and you must have heard from us many times, in the long run, stock prices are slaves of earnings. If you look at last about 12 to 15 odd quarters, and all of both earnings and stock prices have been rebased to 100, there is still some catch up for stock prices to do. And the good part is earnings continue to grow. Earnings continue to grow across all companies. I'll cover company wise in detail, but at a portfolio level, there is still margin of safety. If you look at from about Q1 FY21, earnings have broadly tripled, but stock prices have largely only doubled. Whilst the gap is narrowing, which is a good thing, we still think at the portfolio level, there is some catch up to do since earnings growth continues to remain pretty healthy. In that context, if you were to zoom out and ask yourself, where are banks in the whole cycle? So I've got two data points here for all of you. One is 5-year CAGRs for Nifty. Nifty is sitting on a 5-year CAGR of 25%. But if you look at Nifty Bank, in the last 5 years, they've only delivered 18%. And this is at a time when earnings growth has actually been really strong for most of the banks. So there have been interests that the market found in the last 3-4 years. But if you were to zoom out and look at financials as a whole, I think they are still sitting with ample margin of safety. They're still sitting on valuations which are largely in line or below long-term fundamentals or long-term valuations. And from a return perspective also, you see there's still catch-up to play if one were to compare yourself to Nifty. So at the benchmark level, not only at the portfolio level, like I had shown in the last slide, even as at the space, financials as a space or banks at a space, I think there's still room for catch-up. If you look at financial year till date, about 10 odd months, Nifty banks have actually done better, although returns are marginally better. But this is a space where I think there's enough valuation comfort and enough margin of safety. Going on, Q3 was again a busy result season for us. And I thought it's a good time since most of the results have come in. It will be a good time to assess portfolio performance. In this context, the first thing to talk about, the much heated debate has been around asset quality. Is India is going through tough economic cycle? I thought as lenders are direct play on the economy, it will be a good time to reflect on asset quality. If you look at the last two bars, which is a comparison of 9 months FY24 and 9 months FY25 data, all we're trying to show is what is the gross slippage. Gross slippage is essentially nothing but out of 100 rupees of assets that a bank has lent, how many of them has actually turned GNPA, which is on how much loans you are not getting your EMIs back and they've been overdue for 90 plus days. If you look at the data for HDFC Bank in 9 months FY24, which is last year 9 months FY24, the number was about 1.5%. In the last 9 months, that number is actually down to 1.32%. So HDFC Bank asset quality in the current year is actually trending better than last year. Similar outcomes for a City Union Bank, similar outcomes for an ICICI Bank. The only space where we've seen marginal increase in gross slippages are Kotak and Axis. Both of them, in fact, if you look at Kotak in Q3, the gross slippage number was actually lower. So by and large, I think 3 out of 5 lenders are showing data points which reflects asset quality is in a very good shape. 2 lenders have seen an increase, but the increase is pretty marginal. If you look at Kotak or ICICI, I think these gross slippages numbers are pretty much in line with long-term trends. The stress where we did see some stress was Bajaj Finance. All of you would know, obviously, this is a large unsecured player, and all the problems that we have heard in the market are largely product specific and largely in unsecured. So no surprises. Bajaj Finance against a 2% slippage rate reported about 2.7 in 9 months. But the good news, if you look at directionally, this number used to be about 3%, 3.5%, it goes to about 3.2% in Q1, is now down to about 2.5%. So directionally, I think the numbers are moving in the right direction. We think Q4 could actually be even lower. So the worst of asset quality for Bajaj at least is largely behind. I would say similarly for Chola, directionally again, numbers from 4.5% are now down to 3%. For other 3, I think the numbers are largely in line. So if you look at Aavas 0.6 or 0.7, Home First is actually from 1.6 to 1.4. So only space I think where we saw a bit of a negative surprise was Bajaj and Chola. In both, we are pretty comfortable with the direction with which the asset quality is moving. Other than that, I think whatever the broad brush of economy, I think the good quality lenders have survived many cycles, and I think the current cycle is nothing but a replica of what has happened in the history. Good quality lenders tend to survive bad cycles really well, and the data is a testimony to the same. Moving on, this is this is a fundamental check on the portfolio. If you look at the bottom part of this table, KCP is consistently delivering. In Q1, the earnings growth was about 24%, in Q2 about 18%, and similarly Q3 was 18%. This is at a time when most estimates would tell you that Nifty earnings growth is about 5 to 10%. So at a portfolio level, when we construct the portfolio, when we're looking with a lens that we want to deliver about high teens earnings growth, I think portfolio is well on that direction. A couple of additions, and I'll draw your attention on those. We talked about Go Digit and Credit Access. These are names that we have added in the portfolio recently. Microfinance is a space which is where Credit Access operates, as most of you would know, is going through extremely tough times. And as Tej mentioned, our job is to be a bit of a contrarian. And I think Credit Access is one name which is the best amongst the microfinance lenders. And this is one small position that we have made. Obviously, the company has delivered losses in the last 2 quarters, but I think we could only find value once the stock was down 50% from the peak. And we think the worst on the asset quality is largely behind. Valuations were in favor, and that's when we bought into that. Go Digit is doing really well. This is led by, in our view, one of the guys who knows insurance the best in the country. Pretty solid earnings growth, as you can see here. I think this should continue to do really well. Again, as Tej said, only when valuations turned comfortable, the stock was down 20-25% from its peak. We have taken a small position, but from an earnings growth outcome, I think Go Digit continues to deliver really well. Otherwise, in total, I think if you would look at the portfolio level, as I said, we target high teens earnings growth, and fortunately, KCP continues to deliver on that. Moving on, this is a slide that Tej had discussed already. I won't take much of a time, but there's one interesting point to discuss here. Is this is all selection of sectors that we could select. For example, as Tej mentioned, capital market space is a space that we like really well. But some of you may come back and ask, hey, there were 10 names in capital market. Did you select the right capital market company in the portfolio? And this is exactly what I'm going to show you on the next slide. So this is again a bit of a busy slide, but I'll clear it for you. What you're seeing in blue bar is essentially the category return. For example, capital marketplace would have about 10-12 names, and those 12 names, the median returns in FYTD, which is April to Feb, say capital market as a group has delivered 30% returns. Now, what does the red bar, which is 33%, what does that show? That shows is perhaps out of those 10-12 names that were available to us, whom did we bet on? So we bet on, as most of you would know, we had our bets on Prudent and Motilal. What we do to show this 33% is what were our weights. So supposedly if the weights were 5% each in Prudent and Motilal, so all we do is, as a capital markets as a bucket had say 5% each in Moti and Prudent, which essentially means half in each of them. So we multiply the returns of these stocks by 50%, which is the weight within the capital market space, and similarly for Prudent and similarly for Motilal. So which tells you that when the category had given about 30% returns, our selection allowed us to outperform, and our selection of capital markets gave us 33% returns. Similarly, if we were to see in top private sector banks, the category gave us 8%. The category gave us 8% returns, but our selection and our position sizing allowed us to deliver 11% return. Similarly, affordable housing financiers, there are about 5 or 6 of them listed. The category return was 7%, but we had our bets on 2 different names at different points in time. Earlier Awas and now Home First. We are sitting at 25% returns for the year in affordable housing finance. Similarly in cash management, similarly in regional banks, similarly in multi-product NBFCs. So not only are we allocating capital to low risk names, like I had shown in the last slide, where we've also been able to find the right player within the subsegment. And mind you, in all of this, all of these 10 categories, this is about 70 stocks in total. So we have to pick the right stocks in the right categories. First, we have to pick the right categories firstly, and then beyond that, we also have to pick the right stocks in that category. to deliver the outperformance that we have delivered. Moving on, concluding, this is the final slide of the presentation. As we had shown earlier, if you look at the consistency of returns, and consistency helps you kind of sit through and stay invested for a long period of time. If you look at last 8 to 10 quarters, the KCP at a portfolio level continues to deliver earnings growth, which is the blue bars. Earnings growth is upwards of 15. In some quarters, it's actually been 20, but upwards of 15%. ROEs at the portfolio level continues to remain in the tight band of about 16 to 18 odd %. And price to earnings for the portfolio is within the band of 20 to 25. Now, you were to contextualize these to the index. Index gives you ballpark, let's pick Nifty. Nifty gives you about 12% earnings growth in the long run. Nifty gives you about 12% ROE. And Nifty broadly trades at about 18 to 20 times earnings on a trailing basis. Now, KCP is delivering about 30 to 40% better on an earnings growth. We're delivering about high teens. So against 12, we're delivering about 18. Against a 12% ROE, we are again delivering about 18. But on price to earnings, this is only about 15 to 20% cheaper, which is essentially telling you for delivering variables on fundamental variables of about 30 to 40% better than index, KCP is only 20% expensive than index, which is giving us enough margin of safety to continue to stay invested in the portfolio. I think that was our presentation. I think we should take Q&A, KB.
Sure. Thanks, Tej. Thanks, Keshav. This was quite insightful, and of course, we got a lot of details. So we have quite a lot of questions. If I can broadly categorize them, a lot of them are about different set of stocks. But let's start with one, which is now pretty widely discussed. So Marcellus has spoken at length about how household Indian balance sheets are in their worst shape since 1970s, and that's quite unprecedented. What sort of impact can the same have on our portfolio holdings, and how are you thinking about this macro situation?
Yeah, I think we've seen the highest amount of balance sheet leveraging in about 3 years. If you were to take any rolling 3-year period of time, because post-COVID, we saw unsecured loans growing at anywhere between 20 to 25%, while nominal GDP was not growing at more than 9 to 10%. And that has resulted in a situation where up to end of calendar year 2023, till the RBI increased risk weights, all lenders were growing unsecured loans at about 25% plus. What that resulted in was obviously an accident waiting to happen. And what we first saw, the first casualty that we saw of that was microfinance over the past 12 months. And as soon as the RBI increased risk weights, there was some increase in risk. Microfinance as a sector completely collapsed. That's part one of what's happening in the sector. Part two is the second layer of stress which came through was small fintech companies. Again, the way stress works or risk works is it starts off from the highest and the most riskiest segments and gradually moves up the risk curve. So it started with microfinance, then went to fintech lenders, the smaller ones, then moved up to small ticket unsecured loans, even for NBFCs. And then it moved up to credit cards. Even for larger lenders, their credit card book has started seeing stress. And then finally, it's percolated upwards to some of the lenders. But however, what this does is, as a portfolio, we have about 35% of market share in lending. So what I mean by that is HDFC, Kotak, Bajaj, if you add up all of their loan books, altogether, we own about 35% of India's lending sector, all of them put together. Where we have started to see stress, or where we had started to see stress, was microfinance, which is less than 1%. Our exposure to microfinance then was 0. Next layer where we saw stress, fintech companies. Our exposure to that was 0. The next layer where we started to see stress was small NBFCs, mid-tier NBFCs, which were doing unsecured loans, two-wheeler loans. Again, our exposure to that, 0. Finally, the stress percolated upwards. It moved to a Bajaj Finance. Parts of Bajaj Finance's book started to see stress, obviously a large position. However, Bajaj Finance has had not seen any slowdown in lending. Bajaj Finance is gaining market share. It's growing its unsecured loan book at 30%. Rest of the unsecured sector is growing now at 10 to 12%, 3x faster than the sector. So we are seeing this as a great opportunity to gain market share for almost all our companies. HDFC Bank for about 2 years was not growing its unsecured book or its credit card loan book. In the past 6 months, it's growing its credit cards at a pace which it has not grown at in the past 3 years, because everyone else is withdrawing from the sector while HDFC Bank is finally seeing space in the sector. So as you can see on the screen, there is no significant stress that we can see in our companies. Household balance sheets are weak. What that has led to is some of the weaker lenders are seeing a lot of stress. That is giving a lot of opportunity for most of our lenders to gain market share. And that's why you're seeing in the last 6 months, most of our lenders have not seen any drawdown. The market is also starting to recognize that. While the rest of the market is seeing a drawdown, the rest of the financial services players are also seeing a drawdown. But these select few names on the screen, they are not seeing any sort of drawdown.
Sure. Thanks, Tej. So the hot question here. What IndusInd Bank has reported, how are our processes protecting our portfolio companies from that? Or the other way to say the same thing is that what are our measures to ensure that none of our portfolio companies have this kind of an issue? And how are we dealing with banks who have derivative exposure?
So yeah, I'll cover how are we dealing with it. Keshav can cover the IndusInd piece. What we are seeing or what we are doing is what is our philosophy, and we've shown that in good times or in bad, we stick to what our philosophy is. We stay away from things we don't understand. We stay away from things we don't like. We stay away from things which are extremely risky. And this is extremely true, and we take it to an extreme when it comes to lenders. There are maybe names we can count on our fingertips that we would want to own in the lending space. All the risk that we want to take, we take on the non-lending side. We don't venture out and do things on the lending side unless we're extremely convinced or these are names which are there and have existed and have done well for 10, 15, 20 years in the market. So the names which are there in the portfolio, top 4 large banks, 2 large NBFCs, and then a handful of smaller names. Those are the 6 or 8 or 9 names that we would want to own. And that's it. We don't venture out of that list when it comes to lenders. So hopefully we would not see something like this when it comes to our names. When we see something like this, we saw Kotak, right? We saw Kotak hitting a lower circuit. It is not because of governance reasons. It is hopefully for things which are solvable. It is for things which will be solved in hopefully 12 months time. And these are players which don't risk their balance sheet. Maybe earnings will take a hit, but their balance sheet will hopefully never take a hit. So from a construct perspective, we try, and we're extremely paranoid when it comes to lenders. We try and see that irrespective of what's happening in the outside world, we don't have to deal with such a situation.
Yeah, I mean, just to add, anyone claiming that they could have figured out earlier that this could have unfolded the way it unfolded in IndusInd Bank, it's actually pretty difficult. The issue is about an internal process that do you hedge some of your liabilities or do you not? And banks could end up having derivative liabilities. You could have, liabilities in general raised in foreign currency and unhedged. So it is extremely difficult as an outsider to know, and it actually comes down to the process. It actually comes down to the risk practices that the banks have shown. And for this to happen at IndusInd, it's not new. I mean, if one does basic channel checks and goes on ground, the kind of loan practices that the name has in other businesses also has been questionable for a while. And hence, today, IndusInd Bank does not even form part of coverage at Marcellus. So, I mean, it's very difficult to pinpoint if one risk one could have known earlier. It is about broad risk management at a lender. And one can figure out some of these practices if you spend some time on the ground. And I think IndusInd was not new, at least in terms of lending practices. This time, the problem was found in somewhere else. But it's known for sub-quality risk management for a while now. It's not new.
Sure, of course, that helps. So, Tej and Keshav, here are 2-3 questions which I'm clubbing together regarding our capital market discussion. While Keshav put a detailed note on that, but I'm just referring by an investor that what are the discussions which happened when we were entering into these portfolios? I mean, was it pure P related opportunity which we saw, or there was a more qualitative long-term play? That is when we were entering, and of course, when we were exiting. Other than valuations, were there any other concerns on this?
Keshav?
Yeah. No, sure. We like the space, as Tej mentioned. Structurally, we think, whilst all of financialization of savings is a theme which is really true. Over time, Indian households have not only financialized their assets, they're also moving their assets from just bank deposits or corporate deposits to equity. This is where a lot of capital market plays become pretty interesting. From a business construct perspective, this comes with no balance sheet risk. This is actually throws a lot of free cash flow, and this is a segment where as I was saying, the macros look pretty interesting. The only risk one takes when you buy into capital market names, it's cyclical. As the name suggests, capital markets, as all of you know, markets tend to be cyclical. So you buy into cyclicality. The only way we can counter some cyclicality is if we have enough margin of safety when we buy. So I remember when we bought into Prudent about 3 years back, the stock was trading at 20 times earnings. And by the time we exited, these are valuations that are shown in the bottom of the table. These are valuations as on 30th October, which is when we looked at these charts and we asked ourselves, are we willing to buy cyclical businesses at 40 to 50 times earnings? And the answer was clear no. So only framework that we ask ourselves is, do we have enough margin of safety when we buy into these businesses? Because it's virtually impossible for us to say that the market has bottomed and from here on, market will do well and hence capital market names. No, that's not the play. The only play is for us, entry valuation need to make sense. For us, earnings growth visibility needs to be there. And when both of these come together, we tend to take opportunities, but it's a space that we like, given the construct, as I mentioned. We will continue to look out for opportunities, but valuations need to correct further, I guess. We've already down 25-30% on most capital market names, but remember they were sitting on 100% gains. There could be some more downside, but we'll look out for those opportunities as and when they come.
Noted. Now here is a question which is about current markets and how investors should go ahead and do. So what do we do in these tough times if we have cash and if we don't have cash? I'll take this. So broader thing here is that every investment decision needs to be seen and guided by how your asset allocation is going. And it's quite important because if you're over allocated to equities in times like these, it will be quite stressful. And of course, portfolio will see sizable amount of damages. And let's say in times like 23, 24 calendar year, if you are under allocated. So the broader perspective is that your asset allocation should be in place, follow the discipline, and keep investing at regular intervals guided by your asset allocation. That's from our end. This was more on investor behavior. Let me quickly move to this is a question to both of you. What were the learnings in the period of pain, and what are the structural processes which we changed, if any?
Yeah, I think pretty important question, good question, because what we realized during this period of time was two things. One is we needed to expand beyond the handful of companies that we knew about, because unless and until we had something else to go to, barring the handful of companies we knew, what could we have done? So for example, today or say 6 months ago, we exited the capital markets. Where are we supposed to park that capital? Unless and until we have 5 other options, what could we have done? And because we have those options today, we are able to make these choices because we have access to an ICRA, or we have access to CMS. These are names, all of them which we have added in the last 2 years, KFintech, Prudent, so on and so forth. So number one was we added a long list of names. We now have access to about 25 management teams, which we believe we know. We have access to 25 companies, which we think we can buy into KCP. Hopefully that number will be 30 by the end of the next 6 months. At any given point in time, out of those 30 companies, we will be able to buy quite comfortably with a decent margin of safety, at least 10. So number one was we've created that pool. Number two was we had to get a better handle on what was the fair value of these businesses. We knew the qualitative aspects, we knew those businesses inside out. Rather than getting into more depth of those businesses, we had to know how much are those businesses worth steady state. Assuming everything else remains equal, assuming that the world remains normal, what is the worth of a Bajaj Finance or a HDFC Bank or a Kotak Bank? And relative to that, what is the worth of a Prudent Corporate or a Naukri or a CMS? Those were the two largest things that we had to do. One was add to coverage. Second was figure out what are these businesses worth? When do we need to check out of them? And when do we need to buy them aggressively? After that, I think it's a game of patience and then being extremely aggressive once you get your price, both while exiting and while entering. We don't do much with the portfolio. We prefer to stay away from it as long as the businesses are working out to be fine, unless the valuations have reached to extreme levels. We stay away and stick to what we own. We just monitor what's happening quarterly at a business level. The quarterly results are a good check post to tell us that whether the businesses are tracking what they're doing. And then, like I said, we think of ourselves as business owners. Unless we get a great price that the market is giving us to exit the stock, we exit. Other than that, just stick to what we know.
Sure. And here is a question regarding our holdings, and this is a related one for HDFC Bank and Kotak Bank. I mean, is there any chance that we are, we are blindsided by a sunk cost fallacy in terms of HDFC Bank and Kotak Bank and waiting for them to turn around because it's been quite long?
So there are two answers to this. One is what the business is doing. Is Kotak Bank losing market share? Is Kotak Bank seeing significant stress on its business? Is Kotak Bank seeing deposit market share loss versus all the top 4 private banks? We don't see any of that. Same questions we can ask for HDFC Bank. Has credit culture changed? Is it losing market share? Is HDFC Bank loosening credit standards? So on and so forth. We don't see any of that. These questions were extremely pertinent till about a year ago as well, because endowment bias, as you would call it, on HDFC or Kotak was extremely pertinent 12 months ago. If you look at last 12 months, both HDFC and Kotak have outperformed the market broader indices, any of the indices, by about 15 to 20%. If you would have taken this call a year ago saying these are boring businesses, why don't we try and do something else and move out to some of the businesses which are more exciting, higher growth, better future, so on and so forth, we would have regretted it sitting here. And on this slide, right, while we spoke about moving to businesses like KFin, Policybazaar, Ikra, Naukri.com, we are in no hurry. We are not going to do this in the next 3 months, 6 months, 9 months if valuations are not favorable. We'll do this as and when valuations permit us to do it. We'll stick to what we know if the valuations don't permit us to do this. If these businesses are not available at great valuations, we are in no hurry just because we want to tilt the portfolio a certain way, or just because there is some favorable mix that you want the portfolio to look like. We want the portfolio to be a portfolio of companies which are available at less than fair market value and which are growing at 15 to 20%. That is our objective number one. Then
Sure.
everything else
last 2 questions, Tej, Keshav.
Yeah.
One is regarding cash in the portfolio, whether we should be raising it at this point in time, or are we comfortable fully invested?
No, actual cash in the portfolio is about 10%, which we are finding opportunities now. We'll be deploying shortly in some of the names. We're not likely to raise further cash in the portfolio.
Okay. And there's a question on HFFC. That was valuation the only ground when we sold, and is that now reached to our palatable levels, or do we see more to it?
Keshav?
Yeah, no, absolutely bang on. I think valuation was the only reason. We like the company, we like the space. We've been invested in a couple of affordable housing financiers. We particularly like Home First. We just, as a construct, don't like paying 4 times book value for a business which is capped ROE, a single product company. The day we saw Bajaj Finance and Home First trading at the same valuations, we asked ourselves, do we want to be invested in both when ROEs are very different, when management quality is very different, when credit ratings are very different, when parentage is very different? And I think the answer was very clear to us, and we checked out of Home First. Stock, I think, didn't do anything for a year. And then when it was down 20% from its peak, 20-25%, valuations were looking far better. We checked in. I think, yeah, valuation discipline continues to remain the most important part of our exits. I don't think our companies have given, other than that, enough reasons for us to check out, fortunately.
Sure. So there's one final one, Tej. I think we should answer this, and this is particularly from, let's say, cohort of investors who joined us in 21 calendar year late. Is that the performance for those investors today also is disappointing vis-a-vis when we look at, let's say, broader market indices. So how, while you have answered that, but specific to, let's say, this time period, how do we look for next 1 year, 2 year, 3 year period, and what's our advice to this set of investors?
Yeah, I think incrementally from here on, if you look at our portfolio earnings growth of 15 to 20% versus market at 8 to 12%, given what's happening in the broader financial services ecosystem, our style of investing is likely to do pretty well for the next 12 to 18 months is the visibility that at least I can see. Beyond that, we don't know. What did not work in our favor in 2022, especially, which is the period of pain, most of those factors are behind us. There is no recovery insight from NPAs. There is no low base of valuations for most companies. There is no low base of valuations or of NPAs or of profit numbers for a lot of PSU banks. So most of those things are behind us. And therefore, from incremental perspective, we are still sitting at decent valuations. It's not that valuations have run ahead of themselves for financial services. So we can see not only 15 to 18% earnings growth, but a bit of re-rating, especially for the large cap lenders. If the current environment persists, that is something that over the next 12 to 15 months we'll see. On a relative basis, will be, I think, much better off than a lot of other parts of the market because of this sort of visibility. On an absolute basis, very difficult to predict. We can see a lot of macro things going wrong, global uncertainty playing out. But on a relative basis, we should be in good stead over the next 12 to 18 months.
Noted. So that was the last question for the day. Thanks, Tej. Thanks, Keshav, for taking time out and getting into an interaction with our investors. We'll continue to do this at regular intervals. And in case there are any more questions which are left unanswered, please send us an email and we'll be happy to connect back with you. Thanks. Thanks a lot.
Thank you. Have a good day. Bye.